Good morning, ladies and gentlemen. Welcome to the Sasfin Results presentation for the half year to 31 December 2020. And thank you again for your interest in our share. It was a tough 6 months for Sasfin. Our clients were undoubtedly affected by the lockdown, and this of course translated into slightly lower income and higher impairments. And we also felt the challenges being faced by the Land Bank. But I must say I'm proud of our team. They have done extremely well in the circumstances. They have returned the group back to profitability, but equally importantly, they have provided a very high level of service to our clients. There are many positives in the half-year results. The cost-to-income ratio is down some 4%, and Michael is predicting that it'll come down even further towards the end of the year when we move into the new building, which will require less space. There's been very strong performance from the wealth pillar, and we've also received the proceeds of the sale of our stake in Efficient. But probably most important from a board point of view, we're still in a very strong capital adequacy and liquidity position. I'm predicting a better 6 months to June, but of course that is highly dependent on impairments. But as the President said in his family chat on Sunday night, I do see some green shoots in the economy, albeit very small, but the second 6 months hopefully will be better. Before I hand over to Angela to go through the detailed results with you, I want to thank the board, Michael Sassoon, and the entire team for the way you have operated during these very tough and very uncertain times. And I know many of our staff are listening in, so I want to thank them most sincerely for their dedication. Behind each staff member is their own story, their own challenge within their families with regard to COVID-19. So to the staff, thank you very much for your resilience. And on that note, let me now hand over to Angela, who will take you over the detailed results. Thank you.
Thank you, Chair. By way of agenda, I will run through the financial review and then hand over to Michael, who will do the pillar review, the prospects and the questions. In terms of key features, for the 6 months to December 2020, our performance metrics by and large are negative compared to prior year, evidencing the very challenging economic environment we find ourselves operating in. Although, as the Chair has mentioned, we have returned to profitability since June 2020, our headline earnings is down 65.82% to 26.7 million compared to the prior year, primarily due to increased impairment charges because of the impact of COVID-19 and the associated lockdown on South African businesses. Total assets have contracted by 13.57% to 12.6 billion, which is in line with the 13.42% decline in loans and advances to 6.4 billion due to the tightening of credit and lower volumes. Despite this decline in loans and advances, total income is only marginally down 1.45% over the year. Positively, assets under management and advice grew by 10% to 52 billion over the year, which is a record high for the business. Foreign AUM comprises approximately 35% of total AUM and grew 24% year-on-year. The group's cost-to-income ratio improved meaningfully by 3.85% to 70.48%. on the back of realized proactive cost management initiatives. On our headline earnings, total income, including associate income, is marginally down to 633 million. Key drivers to performance are an increase in asset finance revenue from improved margins, which was offset by lower volumes. The strong growth in the wealth business is on the back of the sale of the Efficient investment as well as foreign income. The capital pillar's decline has been severe and has taken into account a net mark-to-market write-down in the current year versus a write-up in the prior year. In addition, we experienced lower utilization in facility limits within our trade and debtor book. Lastly, The beyond business banking revenue has remained largely flat, with growth in transactional banking offset by lower volumes in Forex. On the credit impairment charge, it has increased by 185% to 130 million, resulting in an increase in our credit loss ratio from 122 bps in the prior year to 240 bps in the current year. Although we are operating in a very high credit risk environment, our credit loss ratio has improved since June 2020, where we recorded a 303 bps credit loss ratio. Moving on to costs. Optimization of costs has been a key strategic focus area for the group. We have, over the year, rationalized business units and optimized structures where appropriate. We exited our lease agreement for the wealth business and kept a very tight handle on headcount. We are comfortable with the progress we have made to date in our improvement, and this is evidenced by the decrease in costs by 6.55% and with the CTI of 70.48. Finally, on the slide, our effective tax rate at 30% is due to the capital gains tax we realized on the sale of our efficient investment. I have spoken through most of the movements on this graph, and as one can see, the impairment line is the largest contributor to our low headline earnings performance. All things being equal, if we were tracking closer to our through the cycle impairment range of around 150 bps, our performance would have been closer to our prior year levels. In terms of the long form of our income statement, I've chatted through most of the lines. The only notable on there is the headline earnings adjustable item, and to identify that that is the after-tax impact of our sale in efficient, which is not accounted for headline earnings purposes. On our ROE, we are at a low point of our earnings. However, looking forward, as we work through this COVID-19 credit cycle, our impairments will normalize in time, having a direct positive impact on our earnings and our ROE. As mentioned, our cost to income ratio is absolutely heading in the right direction, and there are still more business optimization initiatives underway that will realize further savings. Strategically, we would like to see our cost to income ratio below 70%. Moving on to the balance sheet, our core funding is down 1.96% to 8 billion. Customer deposits have declined, with call and notice deposits increasing over the period. However, this growth was offset by a decline in our NCD balances. Long-term funding is down 15.25% due to normal runoff and amortization. We do, however, have new funding lines of circa 390 million available and still for drawdown. The balance sheet remains strong with net available cash at 2.3 billion. Moving across to loans and advances, which are down 10.15% to just under 7 billion, again due to that tightening of the credit as well as lower new business volumes over the period. We have experienced reduced volumes in the asset finance book, which is down 6.52%, reduced utilization limits in the trade and debtor book. We have also exited certain clients to proactively manage our risk in this book, resulting in our credit performance being very well contained. Growth in specialized lending has increased by just under 27%. This is a well-secured book and that has performed well over the period. Again, the long form of our balance sheet on the asset side. A key notable on this slide will be the intangible assets and goodwill, which is down 12% to just over 202 million. We continue to invest in strategic IT projects. And as our new systems come online and is embedded in the business, we are amortizing them in line with our policy, and hence we are seeing a nice reduction in this balance. In terms of our IFRS 9 summary, at the outset, we can see that our stage 1 exposures have declined by almost R1 billion, which speaks to the tightening of our credit and the overall decline in new business volumes. During this period under review, we have performed a semi-annual recalibration of our credit model, as well as an update of our forward-looking assumption assessment, which looks at future losses. The net result has been an increase in our expected credit loss, or ECL. Overall, our PDs have increased, which was not unexpected, given that the impact of the lockdown would now be included in our numbers for the first time. In addition, we have seen a migration into stage 2 and stage 3 buckets, with the most impact being on the aging of our exposures in stage 3, resulting in that increase in ECL, specifically in our asset finance book. Our stage 3 exposures, you will note, has come down year on year, as we have benefited from a successful recovery of a large exposure that was in business rescue and carried a low impairment in the prior year. However, this was replaced by an increase in arrears in the asset finance book, which carries a higher provision, resulting in an increase in the overall coverage ratio. Lastly, and not included in the table above, we have raised our ECL on the land bank exposure. This does not include the 12% reduction in the capital we received in February and the proposed equity injection of 7 billion over 3 years tabled by the Minister of Finance at the last budget speech. Our coverage ratio and credit loss ratio are representative of the high credit risk environment. Our focus now is on collections and ensuring that our arrears bucket is stabilized and reducing over time. On the liabilities and equity long form, the only note I'd like to make is around the funding of repurchase agreements, which is down, and that decline is in line with the maturing of our treasury bills, which we've used to reduce these balances. On our core funding base, although we are slightly down from the prior year, as mentioned, we do have just under 400 million of funding lines available for drawdown. On our capital adequacy ratio, the CAR has remained stable over the period and well above our regulatory minimum. The decline in our loans and advances has reduced our risk-weighted assets and has helped in improving our CAR. As you'll notice, in December 2018, our RWAs was almost 900 million above what our current levels are, and we still posted a very strong CAR. We do hence have headroom to grow our loans and advances book and maintain a healthy position from a capital adequacy ratio perspective. Profit from operations. Before handing over to Michael to go through the pillar reviews, I'd just like to make a note around the group services stripe, which you'll see has increased its losses significantly year on year. And that's really due to the impairment charge from the land bank, which sits in our treasury business unit, and that rolls up under group services. And the bulk of the loss is attributable to that balance. I'll now hand over to Michael to do the pillar reviews.
Thank you, Angela, and thank you everyone for joining us this morning. I'll just jump straight in to the pillars. So firstly, starting with asset finance. Just before I jump into asset finance, just to say that, previously we reported on a 3-pillar basis. We've now reported on a 4-pillar basis, the 4 pillars being asset finance, wealth, business banking, and capital. Asset finance really being the largest business within the group, and specifically within the bank, with the largest loan portfolio. And what's pleasing about asset finance is that the income has grown despite the lower loans. And that is because of the margin enhancement that Angela referenced a bit earlier. Unfortunately, this was offset by quite a steep increase in credit impairment charges. And we have managed to control the costs well. I think just to say on the impairments, what happens with IFRS 9 is we recalibrate based on 7-year data. And therefore, as you bring in new data, you drop off your older data. And the newest data does demonstrate a big increase in arrears. As clients struggled to pay in the months of May, June, July, when we were really at the peak of the lockdowns, those arrears balances increased. And so a big part of the increase in impairment charges is the higher arrears levels. But another part of that is then you recalibrate your model based on your most recent history coming in and your oldest history dropping off the model. So at some point, what should happen is your new probabilities of default and loss given default will kind of be in the base. And we should then move towards the cycle credit loss ratio of closer to 1.5% or lower, hopefully. And that will make a very, very big difference to our numbers. And really at a group level, that was the major negative swing. When that happens exactly, does it happen in the next 6 months or does it happen further out? I think it's likely to happen further out, especially if we can expect third waves. And as we see many businesses facing a lot of pressure at the moment. But as long as we don't continue to see large increases in arrears, which is what we expect the arrears experience to start reducing. And we have invested quite significantly in our collections effort because many businesses, unfortunately, got into a habit of not paying when we hit the peak of the lockdown. And we are starting to see some early green shoots from that collections effort, but that will only then come through the recalibration of the IFRS 9 model once the new arrears data starts to come into the model. So despite this 50 million rand or so increase in impairment charges in asset finance, the profit from operations only dropped 18 million. And that's really a very positive outcome given the work that we have done on the margin as well as on controlling the costs. Thanks. The other thing just to note on this slide is that we continue to diversify the book and expand our offering. So today, specialized equipment finance has grown to 22% of the total asset finance book, up from 19%. And we continue to finance other asset types and to go deeper into the credit curve. So our key focus areas is to continue to expand the asset types that we finance, to deepen our credit profile. In other words, and this is quite an important point in terms of a growth prospect for Sasfin. We think that there are opportunities to provide credit to a slightly higher risk profile client, slightly higher risk. The Nasira guarantee that we've gotten from the FMO should help with that to some degree. And we also believe that there might be opportunities for us to reduce pricing slightly to blue chip credit exposure. So we can deepen both into a higher credit risk and into a lower credit risk. The collections remains a very big effort. We now offer pre-discounting vendor financing, which enables normally what we would do in the rental finance business is we would only finance the contract once the equipment's been installed. We will now finance that equipment from the moment that the contract has been signed, even though it hasn't been installed, and that will enable our suppliers to purchase their equipment. And we continue to expand the insurance offering as part of the equipment we finance. The second pillar I'd like to touch on is capital. So we have gone through a major overhaul of what Sasfin Capital is. Sasfin Capital historically was really where we housed our private equity assets as well as our corporate finance business. Today, we are not writing new private equity assets onto our balance sheets, other than in very exceptional cases. We are doing very minimal corporate finance. This business has become a lending-focused business, focused at the mid-market of the economy. And that includes our trade and debtor finance business, which is about tailoring working capital solutions into medium-sized businesses. And that is a major overhaul. So we still have in this business quite a large private equity portfolio of about R500 million, given our balance sheet. And as Angela mentioned, we're earning as a total, we are not generating any return out of that portfolio. So we've got quite a big asset pool with quite large capital against that, not generating us a return. We are in an exit profile of some of that portfolio. There are some very good assets in that portfolio still, and we are in no rush given the strong capital position of the group. And we think there are good opportunities to exit some of those assets, but we need to make sure that we're comfortable that we're getting an appropriate price. And obviously in this environment, it's not that easy to sell assets given kind of the depressed market that we're in. And there are very good assets in that business. So if it takes us a little bit longer to exit, that's also okay. The other challenge over here has been in the trade and debtor finance business. For those of you who've been around for a while, you'll know that we had some difficult credit experience in that business in 2017 and 2018. Fortunately, during COVID and post-COVID, the credit experience of this book has been pretty positive. And I think that's given a lot of the good work that we've done in credit that has resulted to some degree in a lower book. And Angela touched on the lower utilization levels. A lot of that is foreign trade finance. There has been reduced imports. And we have tightened our credit criteria to a degree. And these trade and debtor finance businesses, they are very correlated with the economy. So they need, typically and historically, these businesses have done very well in a high growth economy and have struggled in low growth economies or negative growth economies. And we've got a good team over there, and we've got a good offering, and we are taking on new clients all the time, but that isn't fast enough to replace some of the clients that have left or where there's been big utilization drops. So what has resulted is a much lower income business, both from the private equity and from the utilization. But we are seeing that on the new loans that we're putting on the books, both in terms of the trade and debtor finance as well as in terms of the specialized finance, we are starting to see improved net interest margin. It's a better quality income stream. It's far less volatile. Some of the specialized lending does carry profit share agreements, which we haven't realized any of those profit shares in terms of bringing them to book because it's still a bit early in the life cycle of these loans. But we do expect over time to increase the income in this business again. As you can see, the impairment charges are low, and we have contained the costs very well. We also deconsolidated our insurance business, so that resulted in a drop in income and a drop in costs in this business. And you can see the big drop in earnings in this business. But I'm comfortable that given the asset pool that we have now got on the books, given the valuations that we're carrying the private equity on the books at, and given the type of business that we're doing, that we can turn this into a business which will generate far more consistent and stable earnings into the future. And this is evidenced to some degree by the healthy growth in the property finance and specialized business lending, where we have put on 400 million rand of assets since that initiative was launched about 2 years ago. And we believe that we can continue to grow at a similar rate. And as Angela mentioned, we've got the capital and the funding to generate some loan growth from this perspective. Our investments at fair value have reduced, and we expect that trajectory to continue as we realize some of those assets. Just to say that there are 1 or 2 assets in the private equity portfolio which have taken quite a big knock from COVID-19, and we continue to watch those carefully, but we have rebased all our valuations based on lower forecast cash flows and higher discount rates. So into 2021, we want to continue to grow our specialized lending to optimize the existing private equity portfolio, but while reducing at acceptable prices, to embed the trade and debtor finance and extract those synergies. And then we are looking at growing our private market activities. This is it's a partnership really between Sasfin Wealth and Sasfin Capital, where a lot of our investors, we believe, will want private market exposure. And we're looking at various opportunities in that space. Moving on to the next pillar, which is beyond business banking. So what we did in the last 6 months is we incorporated the foreign exchange offering into beyond business banking. and our foreign exchange business did take a bit of a knock with the low import and export activity. That being said, our income remained largely flat because of the growth in transactional accounts and growth in revenues from our transactional banking business off the back of our digital banking platform Beyond. The other important point to note in terms of income for this business is that it earns some income on the floats. And as interest rates have come down, that's also put a bit of pressure on its income profile. So while the income is flat, that had it not been for big growth in accounts and big growth in volumes, that income would have dropped. We're also now starting to do some lending in this business, and I'll touch on that in a couple of minutes. And you can see that from the merger between the foreign exchange and transactional banking, which really historically operated as two independent silos, we have now managed to reduce the costs. And in doing that, we have reduced the loss from operations, and we are still very positive about the trajectory of Beyond Business Banking. And let me just get into some of that detail in the next slide. Or the next two slides, but just to say that our Hello Payzer relationship is working well. And let me just go on to the next slide. I think I touched on most of this already. We now need to proactively grow our distribution capabilities. We've hired a number of salespeople. We've invested quite significantly into our digital marketing capabilities, and we believe that that will start to generate fruits. There's quite a bit of work that we continuously do on enhancing the features and functionality of our platform, with particular focus on our Forex offering. We see big room for growth in the user experience and the features in terms of our Forex offering and how that integrates into Beyond. And that's getting quite a bit of time from the management team. We also recently just created a capability whereby clients will be able to deposit cash at retailers into their bank accounts. And this is very important for a branchless bank that wants to serve the small businesses which might have quite a big cash exposure. So historically, they would have had to operate through our sponsor bank. Now, any client is able to deposit cash that they receive into any of the major retailers into their Sasfin bank account. But the major focus area for 2021 as well for this business is enhancing the credit capabilities, both in terms of overdrafts and revolving business loans. And that will put us in quite a neat position in terms of the competitive space, as we'll have the Forex, the digital banking with all the digital onboarding capabilities and a good credit capability. We're investing quite heavily into, together with the FMO, towards how we review credit here and award credit in terms of scorecarding and use of data and other mechanisms to achieve that. And we believe that as a Beyond Business Banking unit, there aren't too many digital banks that offer the full credit, Forex, and banking integrated for businesses. The new banks don't offer that comprehensive offering. And while the larger banks do have that, we think that there is still space, especially with SMEs, who often require a personalized service, or they require a solution for high touch where it matters. So we're building the business on digital principles, but often an SME, an entrepreneur, has a specific requirement. And that blend, we think, will be very important in winning in the coming months and years. It's so important to the economy and to the country to get business banking right. We all know how challenging many SMEs find it to interface with the banking system and to obtain credit. And we're very focused on growing this capability. It's been a long journey. We are seeing some good growth in numbers, but there's still quite a road ahead. And we think that getting the Forex digital user experience product at the right level and getting the credit to the right level will make a big difference to this business. It will take a bit of time, but we're comfortable with the trajectory that we're on. And then in terms of the wealth pillar, so Sasfin Wealth really had a great 6 months. That was in part because of the Efficient sale, which was historically accounted for as an associate. We sold that business in December, and we made a decent return compared to what the economy has given and other financial services businesses since we were invested in that business in 2016. We also saw some good growth in foreign income and institutional asset management, which to some degree explains the growth in income. Our local fees were under a bit of pressure. We also took, we have some land bank bonds in our fixed income straddle book, and we took an impairment on those, which reduced income. So the core income actually grew very positively as well in the 6 months, off the back of the large asset AUM growth. But the major growth in profit came from the sale of Efficient. But excluding that sale, we would have still made a 13% increase in profits to the 35 million, and that is due to this record growth in assets under management. Wealth continues to invest in people, the investment process, the investment product range, as well as distribution. And our distribution efforts have really been very positive into the asset management space with strong net new flows. Costs are well contained, and we continue to perform well across our investment solutions. We won another Raging Bull Award for our flexible income fund. I see this week we were just announced as a finalist for our stable fund in the Morningstar Awards. So that's very positive. And you can see that on this slide, as we've moved this business from a stockbroking business, which is the light blue assets under administration, into a fully fledged wealth and asset manager, you can see over the last 5 years, we've grown assets under management from 37 billion to 52 billion. And we believe that there is still good growth for this business. Markets have helped. The markets were strong over the last 6 months, but much of that growth came from net flows and strong performance. And then just in terms of the focus areas, we continue to try and attract and retain top talent, which for wealth business, a heavy RP business, is very important. To invest in distribution, we see opportunities to expand offering locally and more particularly globally in the coming year or so. And then we've expanded our wealth planning offering, where we are now the fiduciary service, which could support some of our high net worth clients. We've invested quite heavily in technology in this business. There's still work to be done to enhance our client-centric approach and to work closely specifically with DMA, which has done really well over this last period. DMA is the old Saxo South Africa, and they're offering a great capability to wealth and asset managers, and they're an associate of ours, and to unlock synergies in working with them. So if you just kind of take a step back and looking at our pillars, we've really got these 2 pillars in wealth and asset finance, which are in a strong position. Asset finance has taken this knock on the increased impairments due to the arrears, but intrinsically, it's a healthy business at the right scale, at a healthy return profile. We need to just get back to a through the cycle credit loss ratio. And we've got these 2 growth areas. We've completely reshaped the capital units, and we are in this big build of the beyond business banking. And we believe that both of those businesses have got good prospects, but we're very much in the early stages of developing those businesses. Just to say, if we kind of look forward from a group perspective, we saw this quote from the chairman of the Bank of England, Bradley Fried, who's an ex-South African. He said that 2020 was the year of survival, 21 the year of repair, 22 the year of renewal, and 23 the first year of growth. And it's been a tough year. And just to say, it's been a tough year from a business perspective, in terms of we've seen so many businesses that have really struggled, and many have failed, unfortunately. And that in part explains the large increase in arrears and impairments. But it's also been a tough year on people. And we see this both for our own people, our staff, and our clients. It's really been a year of isolation. And the mental health issues, globally have increased significantly. And unfortunately, we did lose one of our beloved staff members in the last few months, which also took a big toll on many of our staff members. Fortunately, today, we don't have very few individuals who are still infected with COVID, but it has been a difficult period in terms of the mental health reality. And we're doing what we can to support our staff and to support our clients at this time, which has been very difficult. That being said, I'll just see where we're at today. So just go back to that slide if you don't mind. Just looking at where we are today, we emerge with a stronger balance sheet and a lower cost base. And those cost efficiencies that Angela referenced earlier, we believe that those are very sustainable efficiencies. It wasn't because of a big bonus unwind or a lower bonus provision compared to the previous 6 months. It is a real reduction in certain cost areas. The chairman mentioned earlier that we are looking to, our lease comes to an end in April 22 in Waverley. We're at the end of a very long lease. We believe that there'll be big opportunities to reduce our lease cost while improving our employee and client experience through a move, which we anticipate to do towards the end of this year or early in the new year. We also taking a number of steps to enhance our cost base through exiting some non-core activities, reducing the private equity exposure, etc., which I'll touch on. We've also created 300 million rand in credit provisions over the last 12 months. And that's evidenced by our very high coverage ratio. So that's what we expect. But to the degree that we're able to improve the collections experience in the coming months, and as we recalibrate that through the models, then we believe that there's an opportunity to bring the impairment experience back into the through the cycle range. And we have managed to effectively operate, both in terms of servicing clients and in terms of our staff being able to work from home. So on the one hand, going forward, we want to support businesses in this tough environment. We think that we are well placed to do that. While our capital adequacy has remained flat at around 17%, we haven't appropriated any capital from the efficient sale. We're sitting with quite large money market holdings, which we risk-weighted 100%. So there's an opportunity to grow our loans and advances without that having any impact on our capital adequacy ratio based on our risk-weighted assets and on our capital profile. We are building deeper credit capabilities across the group, as I touched on, which we think will enable us to win more market share across all of our credit businesses. And as the economy opens up, and there were some positive signs from the budget last week, we believe that there will be opportunities for us to grow our lending book. We have, during COVID, we did review our philosophy and our policy for credit in the short-term period, but we think that there will be opportunities. We'll do that while retaining a conservative approach. So that's kind of the one key thing over the next period. And then on the other side, we think that the wealth business, which has had such a good run, has still got much potential, and we are well placed to continue to enable our clients to grow their global wealth. And this is in part through some, when you're building an asset manager, as I think you're all aware, it's very difficult in the early stages to convince new clients, institutions, IFAs to support you because your assets under management are too low. We've now broken through that level, and assets beget assets to some degree, as long as we can retain a healthy level of performance and we continue to develop our distribution capabilities. That's on the one side of the business. On the other side of the business, we've really, clients who've followed us on this journey to global portfolio management have had such a good experience in terms of growing their wealth, and we continue to build those capabilities. So we see good opportunities to unlock the potential of Sasfin Wealth, and that is something which, so on the one hand, there's this big credit focus which supports all of our banking capabilities, as well as the enhanced digital suites across the business banking area, and to grow the lending in asset finance, capital, and in beyond business banking, while at the same time really unlocking the potential of this wealth business, which we believe is in a very good space. And then finally, we have been streamlining our business, and we expect to continue to do that. So we want to consolidate the cost-saving gains, including changing the way we work and moving our head office. We would like to finalize the buyback of the Sasfin preference shares. It's been a bit of a process. We needed to get a regulatory approval, and we've engaged with, under the TRP ruling, with some of the largest shareholders there. We hope to be able to make it in the coming weeks in this regard. We continue to exit non-core activities, thereby ensuring greater focus and reallocating capital more efficiently within the group. We expect in this regard to largely have closed our Hong Kong operation within the next few months, and to release quite a bit of capital that's been sitting over there, which will come back into the bank and help us reduce some costs. And there are one or two other opportunities that we are evaluating. And then finally, to enhance our client experience and distribution capabilities across the group. And that's something which we continue to invest in. So what we haven't done, while the costs have come down, that's not as a result of not investing in sales or distribution. We think we've got a great product offering. There are areas where we need to enhance that further, but we need to expand on our distribution capabilities. So while it's been a very tough 12 months, and we took a lot of pain in terms of our write-down of our private equity portfolio, as well as the large-scale impairments that we've taken in the last 12 months, we believe that we're well placed in terms of our balance sheet, the capital that we've got, the funding lines, the guarantee product in terms of the FMO. We're well placed in terms of our product suite, our people, and we are well placed in terms of rebasing the cost base to some degree, which we think that we can continue to do. So just to also mention that, and Angela did touch on this, we have also got quite a big impairment on the balance sheet against our land bank exposure. And the land bank's obviously a critical entity within the South African economy. It's very important to food security and supporting farmers. And we've always been a big supporter of the land bank. It has been difficult given their defaults earlier last year, but we were very pleased at the effectively 10 billion rand capital that the government or the Treasury has committed to the land bank, 3 billion in the last budget cycle and 7 billion last week. And we think that that will go a long way to stabilizing the land bank, but there still is a journey to go within the land bank before it's out the woods. We have received 12% of our capital back, and they have been servicing interest since September. So we remain positive about the resolution of the land bank, but there's a lot of work to be done over there. So finally, just to thank everyone for joining us. I see a very big group of people on the call. We're happy to take questions, but just to echo what the chair said, to thank our chairman and the board and all of our people, our clients, our stakeholders, and our shareholders on the call today for your support and for your commitment over this time. And we continue to play our role in supporting and enabling businesses to grow while enabling our clients to grow their wealth. And there could be nothing from our perspective more important to the South African economy right now in getting the business sector back up and running again. And some credit is going to be required in that space, and many SMEs struggle with that. And to continue to help investors and pensioners and savers to grow their wealth, which is obviously critically important. So thank you very much.